Now, in revenue recognition, we've said recognize revenue when it's earned and it's realized or realizable. So let's say we sell goods on credit, we get the goods delivered. Have we earned? Yes, because we've delivered the goods. Have we realized? Not yet, but it's still realizable. So we recognize revenue. Realizable means the collectibility of cash for the goods we've sold is certain. We know we're going to get it in 30 days or 60 days. Now, what if we have delivered the goods, we have earned the revenues, but collectibility is uncertain. There's no reasonable assurance that we're going to collect the cash. In that case, it's a question mark on realizability. We haven't yet collected the cash, and whether or not we're going to get the cash for the goods we have sold is a question mark. In that case, do we recognize revenue? Don't know, question mark. So this is an exception. This is the general rule. When it's earned, realizable, recognize revenue. When it's earned but realizability or collectibility is uncertain, then you use exception methods. Under GAAP, we generally use the installment sales method. IFRS prefers the cost recovery method. So basically, when I'm talking about installment sales, what we do is we calculate a gross profit, a gross margin percentage, and as and when cash comes in, as and when cash is realized, revenue is recognized. Why? Because think about it, realizability, collectibility is uncertain. So we wait for the cash to come. As and when cash is being collected, we are recognizing revenue, recognizing profit. Now, in case of cost recovery, what we do is we recognize profit only after the entire cost is recovered. Cost recovery, recover the cost before you recognize any profit. So we'll look at both these methods in pretty much detail now. Before I go on, let me just explain to you the very important term gross profit percentage that we use for installment sales. So let's say we've sold goods worth 500 bucks and the cost of those goods sold are 300. What's the gross profit? That's 200. What's gross profit percentage? 200 divided by 500. So we've earned a gross profit of 200 on sales of 500. So the gross profit margin is 40%. So this is a very important number that you need to know when you're doing problems on installment sales, because we're going to recognize revenue, recognize profit as and when we collect the cash. So let's look at a couple of formulas here. And guys, I know it's difficult to remember formulas. That's why we need to understand the concepts behind those formulas so that even on the exam, we can build those formulas on our own. So let's look at the first formula that we have for installment sales. And this one is very simple. So we know that gross profit percentage is equal to, rather, total gross profit is equal to the gross profit percentage into sales. So we could say the total gross profit is equal to the sales into gross profit percentage. Yeah, this is good. So in this example, the total gross profit is 200. How did we get that? This is 500 into 40%. Now what we're going to do is we're going to break this gross profit down into two parts. One part realized gross profit, second part deferred gross profit. So this is going to be realized gross profit and deferred gross profit. Now, as you can understand, realized gross profit is the amount of cash we've collected. So this would be cash collected into the gross profit percentage. Deferred, what do we defer? What do we not recognize now? Whatever cash we have not yet touched, the cash not yet collected. So you could say receivable into gross profit percentage. So let us say we made the sale of 500 bucks and we collected cash of 100 bucks on the sale. So we've made a sale of 500, but the cash that came in is only 100 bucks. So what we do is we're going to split this gross profit down into realized and deferred gross profit. How much is the cash collected? Out of 500 of sales, we've collected 100. How much have we not yet collected? What's receivable? 400. So you could say the total sales is equal to the cash collected plus the cash collected plus the receivable. So sales of 500, of which we've collected 100, not yet collected 400. So what we do is we multiply this 100 into 40% and this 400 into 40%. So 140%, what's the amount of gross profit we're going to realize right now? 40. What's the amount of gross profit we will not recognize right now, will defer to be recognized in future periods? 400 into 40%, 160. So if you realize, what we have done is total gross profit of 400 is divided into realized and deferred. So realized plus deferred gives us total gross profit. Cash collected and cash receivable gives us total sales. So this was a simple formula that we had when we did GAAP accrual method. When we did installment method, we split it into two parts. Realized, the amount of cash collected; deferred, amount of cash not yet collected. Assuming we collect all the cash, let's say all the 500 is collected. What's deferred then? What's realized? So 500 into 40%, realized is 200. What's deferred? 0. So guys, installment sales means you're going to recognize gross profit as and when you realize the cash. Why? Because realizability is a question mark. It's uncertain. Now we're looking at the installment sales method on page 60. It says under installment accounting, revenue is not recognized at the time a sale is made, but rather when cash is actually collected. The installment method of accounting is used when collection is highlight not reasonably assured or doubtful and there is no basis for determining collectability. And this is especially when the collections are spread out over more than one accounting period. Now under GAAP, sales should normally be reported in conformity with the earnings principle, that's the date of sale. Therefore, the use of installment method in which income is reported as cash is collected normally violates GAAP. However, it is permitted in those circumstances when there is substantial doubt as to the collectability of the receivable and highlight based on the conservatism principle. The installment method is also very commonly used for tax purposes. Now, we have the table there comparing the revenue recognition methods. So, under accrual method, for collectability, you have collection is reasonably assured and degree of uncollectability is estimable. So, you recognize profits highlight when earned and realizable. Under installment sales method, collection is not reasonably assured and there is no basis for determining collectability. So you recognize profit highlight when cash is collected. Cost recovery method, again collection not reasonably assured, no basis for determining collectability. You recognize profit highlight after entire